Tired of watching the market every day? Yeah, I get it. Staring at red and green candles for hours on end, sweating over every minor tick and drop, suffering from just absolute chart fatigue, it can be incredibly draining. But what if there was a way to step back? A way to utilize a much more stable, passive approach to the markets that doesn't require you to predict every single twist and turn? Well, that is exactly what we're going to unpack today. Welcome to today's explainer. We are going to flip the script entirely. See, most people enter the market trying to bet against the house. But what if you could actually be the house? Today, we're exploring the option seller strategy. This is an approach where you literally play the dealer in the index options market. It's a fascinating paradigm shift. And honestly, by the end of this, you'll understand exactly how this powerful engine works. So here's our roadmap for today. 1. The option seller strategy. 2. Understanding time value. 3. 3 key operations. And 4. Managing crucial risks.
All right, let's jump right into section 1, the option seller strategy and what it means to act as the dealer. Think about a casino dealer for a second. The dealer doesn't wait around to see how the hand ends before taking the bets, right? They collect the money right at the start. In the options market, when you sell an option, whether that's a short call or a short put, you're acting exactly like that dealer. The buyer of the option has to pay a fee, which we call the premium, and as the seller, you instantly collect that premium upfront. Boom, the money goes directly into your account the very moment the trade is executed.
And this brilliantly illustrates how that initial transaction turns into a really steady stream of account cash flow. You sell the option, again, a short call or a short put. You collect that buyer's premium immediately. And then, then you just wait. You wait for the expiration date to arrive. The fundamental rule here is that as long as the market index doesn't break your chosen price barrier, which is called the strike price, by the time that expiration date hits, you get to keep the cash. That upfront premium you collected simply becomes yours permanently. No takebacks.
Moving right along to section 2, understanding time value, which is really the hidden engine of this whole thing.
Okay, so the absolutely crucial point here is a concept called Theta. I love this concept because it completely flips the traditional trader's mindset on its head. Normally, traders are racing against the clock, right? But theta is the characteristic of an option's time value steadily decreasing as it approaches its expiration date. When you're the option seller, theta is your absolute best friend. Every single day that passes, the option you sold loses a little bit of its time value. The clock ticking away is actually doing the hard work for you. Time literally becomes your greatest ally. And notice how this decay doesn't just happen at some slow, steady walking pace. As you get closer and closer to that expiration date, the time value drastically accelerates. It just plummets towards zero at lightning speed. And because you are the seller who already collected the premium upfront, that accelerating drop to zero is pure profit for you. The faster it drops, the faster that premium solidifies into your stable cash flow. It's beautiful.
Let's get into section 3, 3 key operations. This is your step-by-step playbook.
To build this income safely and systematically, there are 3 distinct operations you've got to follow. Step 1 is picking out-of-the-money strikes. Step 2 is using spreads to lock in your risk. And step 3 is the actual mechanism of earning that decaying value. Let's break each of these down so you can see exactly how a smart dealer operates. Step 1 is all about probability. You want to pick out-of-the-money or OTM strike prices. What does that actually mean? Well, it means you're deliberately choosing highly improbable price ranges, levels that the index is extremely unlikely to ever reach before the expiration date. Now, sure, there's a clear trade-off here. Because it's so unlikely to happen, the single trade premium you collect is going to be lower. But in exchange for that lower premium, your win rate absolutely skyrockets. You're trading that massive one-time payout for a highly consistent, highly probable string of smaller wins.
Now, this brings us to step 2, and I need you to pay very close attention here. We're looking at a stark contrast between 2 very different ways to play this market. Selling naked options means you are simply selling the option with absolutely no backup plan. If the market suddenly goes against you, your risk is literally unlimited. It's a catastrophic danger. Please, don't do it. On the other side, we have spreads. Using spreads is how you lock in calculated safety. You use them to actively avoid that unlimited risk and protect yourself from forced liquidations if the market suddenly turns on you. So let's dive into some practical spread strategies that our source material outlines. To avoid naked risk, smart dealers use specific tools. You can utilize weekly options to keep your cycles tight. You can execute what's called a bull-put spread, or maybe deploy a strategy known as an iron condor. These are simply multi-leg trades designed to cap your downside. But the underlying principle across all of these is that final bullet point. You must buy further out-of-the-money options as a safety net. Yes, you're collecting a nice premium, but you're also spending a tiny fraction of it to buy some cheap insurance. This guarantees that no matter how extreme a market move gets, your losses are strictly capped.
And that brings us to step 3, regular, repetitive cycles. Once you have your high probability OTM strikes and you've locked your risk using those spreads, the final step is really just rhythmic discipline. You rinse and repeat. You execute these operations on a weekly or monthly basis. By consistently cycling through this process, you are continuously harvesting that expiring time value over and over again, letting the mathematical edge of the dealer steadily grow your account.
Finally, we arrive at section 4, managing crucial risks. Time for a little reality check.
The source material bluntly describes the underlying structural truth of this strategy like this: earn small, lose big. You absolutely need to respect this fact. Yes, your win rate is incredibly high, so you're earning small amounts very frequently. But if a sudden market black swan event occurs, a massive, totally unexpected shock to the system, it can instantly magnify your losses. If you aren't prepared, one lose big moment can wipe out months and months of your earned small victories. Because of that harsh structural reality, there are non-negotiable rules you must follow if you want to survive and maintain long-term stable growth. First, you've got to implement strict stop-loss mechanisms. When a trade goes bad, cut it. Don't hope, just cut it. Second, never over-leverage your margin. Putting up way too much borrowed capital on these trades is a fast track to total account ruin. And third, the source advises you should only enter the market when implied volatility, or IV, is high. That means the market expects big price swings, so the premiums you're collecting are richly inflated. Look, these rules, they aren't just polite suggestions, they are the literal armor that protects the dealer from going bankrupt. Which leaves us with this final critical thought. The math works. The time decay is absolutely real. The strategy itself is sound. But looking at the massive risks involved if things go wrong, do you actually have the strict, unwavering emotional discipline required to truly play the dealer? It's a heavy question, and one you must answer honestly before you ever collect your first premium. Thanks for joining me on this explainer, and I really hope this provided a clear, structured view into the completely fascinating world of option selling. Catch you next time.